Hi, welcome back to lecture 3 on infrastructure finance. What we are going to do in this lecture is to understand some of the basics of financial management, and basically I am going to really look at it covering this topic of financial management over many parts. I understand this is not a course on financial management, but at the same time we are looking at a course on infrastructure finance, and for us to really be able to understand and appreciate the implications of various aspects of finance on infrastructure projects, we will have to understand some of the basics of financial management, and that is the reason why we will have to look at some of these topics and concepts before we actually move on to handle what is the core of this course, which is infrastructure finance. But before we actually get into what we have planned to discuss for this session, I think we have looked at two thought questions in the previous lecture. Okay, so let us try and discuss those questions first. So the first thought question was, what should be the role of government finance in infrastructure development when private finance is available? Remember, we looked at two broad sources of finance. One is public sector finance and private sector finance, and we have also seen that over the last 3 5-year plans the contribution of private sector finance is expected to increase, and though the overall contribution to infrastructure is also expected to increase, the proportion of private sector is expected to increase considerably in the overall contribution. Now we also realize that public sector finance is not available infinitely. There are restrictions in terms of how much public sector can actually fund infrastructure projects because of various reasons like fiscal deficit to be under control and so on. So the question here is, when we have both private sector and public sector capital available, what kind of focus should be given to public sector capital? First is, public sector should actually be given priority when we look at projects that are in economically and situationally disadvantaged regions. There are several regions that are not easily accessible, that are in what is called as in very remote corners of the country. So projects in those countries may not be commercially viable because of various reasons. It could be because of the fact that the area is very sparsely populated and users of these infrastructure projects may not be very large. It could also be because of very tough terrain, and navigating this difficult terrain can actually be very costly. But it is also very important that these remote regions are connected to the mainland and they are connected to the economic development, and it is going to be very difficult to get private sector finance to invest in projects in such regions. So therefore, when we really look at prioritizing public sector finance should be channelized to projects in economically and situationally disadvantaged regions. The second priority for public sector projects could be in terms of providing what is called as viability gap funding. Now what is this viability gap funding? When you want to attract private sector in infrastructure projects, there are some projects which, if it is entirely funded by the private sector, may not actually be financially viable. So the private sector might not be in a position to get adequate financial returns if it is completely funded by the private sector. Now we all know that for a private sector to make an investment in infrastructure projects, they need to get adequate financial returns. If the returns are going to be very difficult to come by, or if they do not meet the benchmarks that are set by the private sector, then it is unlikely that any investment will happen. So to ensure that there is private sector investment in those projects that are not viable if it is completely funded by the private sector, the government can, or in many instances it provides what is called as a viability gap funding. A major difference between public sector and private sector capital is the cost of capital. The private sector cost of capital is higher as compared to the public sector cost of capital. So, a project, if it is funded entirely by the private sector, has to generate adequate returns to meet the cost of private capital. On the other hand, if it is funded partly by public sector capital, which is not so expensive as compared to private sector capital, then the returns need not be as high as what it would need to be if it is funded entirely by private sector capital. So, this is a viability gap funding to ensure that the private sector returns are met, and this funding helps to bridge the gap in returns that would have otherwise come up if it is funded entirely by private sector. In many cases, the viability gap funding is to the extent of 20% of the project cost. So, 20% of public sector funding leads to an investment of 80% of private capital. Whenever there is a need, this 20% can be increased by another 20% by contribution by the state government, and therefore 40% of government funding will help to attract 60% of private sector capital. Now, we have to remember that without that 20% or 40% viability gap funding, the entire project would not have been financed by the private sector. So, another role of public sector finance in today's context is to channelize private sector capital to infrastructure by leveraging a small amount of public sector capital. Now, let us go to the second thought question. The second thought question that we posed was, why are state infrastructure projects more dependent on budget support as compared to central sector projects? We have seen that broadly in terms of financing, projects can be classified into three categories: center projects, state projects, and private sector projects. And the way in which these are being financed is also given in the table. For example, the center projects, 26% of the cost is met through the budgetary outlays, the remaining 20% in terms of internal generation or through external equity, and 52% is in terms of borrowings. But if you look at the state project, 66% of the project cost is met through budgetary outlays and 10% by internal generation or equity, and 24% in terms of borrowings. So, if you look at the center projects and the state projects, we find a substantial difference in terms of the amount of investment from budgetary outlays. Why is this? What could be the reason? Okay, before we actually look at the reasons, let us also understand the kind of projects that we actually see in the state sector. What are the infrastructure projects that come under the purview of the state government? Normally, this would include projects such as irrigation, water supply, sanitation, sewerage, electricity distribution, and so on. Now, what are the nature of these projects? If you look at the nature of these projects are very politically sensitive. They do not have adequate commercial viability, particularly in the Indian context. For example, if you look at water supply today, in the Indian context, it has become very difficult to actually price water to recover the cost. And more importantly, all of this are considered to be socially important from a developmental perspective. Water supply, sanitation, sewerage, access to electricity, all of them contribute significantly to economic development, and access to this products and services should be widely available across all segments of the society. So when we look at projects such as this, many of them might not be commercially viable to recover the returns by the private sector, and therefore they are all financed substantially by budgetary outlays. So we will have to remember that there is a very tight linkage between the sources of financing and the characteristics of the project. Before we actually try and get into details of how do we actually finance an infrastructure projects, we should also consider the characteristics of these projects, the context at which these projects operate, and the importance of this project to socio-economic development, because these factors can play a very important role in how these projects are going to be financed. Okay, now let us move to what we are supposed to cover in this lecture, which is to understand the basics of financial management. Okay, before we actually get into the basics of financial management, we also have to understand firstly what are the different forms of business organizations that we see today. The first is what is called as your sole proprietorship. In a sole proprietorship, there is what is called as a single owner. The owner is the business is not very distinct from the owner. If you really look at examples of sole proprietorship business, let us say the street corner kirana shop, this could be mostly are on a sole proprietorship basis. The next form of business organization that we come across is called as your partnership. In a partnership form of business organization, there are more than one owners, like we have in the case of sole proprietorship, where the business has, or the owners of the business has unlimited liability. In many forms of partnership, you also have what is called as an unlimited liability clause. There are different variants of partnership structure which gives limited liability to the partners, but by and large, if you really look at it, a partnership form of business organization has what is called as a unlimited liability. What could be the common examples of partnership form of business organization? Many legal firms, chartered accounting firms, they are all structured as a partnership basis. The third and the commonest form of business organization is what is called as a corporation. How is corporation different from the other forms of business organization that we talked about just now? Okay, what is a corporation? A corporation is an entity that legally functions separately from the owners. Unlike the proprietorship form of business, here the owners and the business are separate. In fact, there is a very nice definition given by Justice John Marshall on a corporate form of business organization. He states that corporation is an artificial being, invisible, intangible, and existing only in the eyes of the law. So unlike human beings, a corporation does not have a physical entity, but at the same time it is considered as a distinct entity in the eyes of the law. Like individuals, corporations can sue others. It can also be sued for any wrongdoings. It can purchase property, it can sell property, it can own property. So like most of the other actions done by individuals in terms of property and asset ownership, corporations can do the same as well. And if there is any wrongdoing by the officers of the corporation, they can be subject to criminal punishment under the existing laws of the land. Why do we see a corporation is the most common forms of business organization. Remember, I want to stress the fact that we are talking about business organizations. There are other forms of organizations that we need to be cognizant of. For example, when we really look at non-business organizations, it could be an education institution, it could be a voluntary organization, it could be a non-governmental organization, it could be a charitable organization, and so on. So they are commonly structured as a society, they are structured as a trust, and so on. But we are going to mainly look at a business organization, and when we look at a business organization, corporation is the most common form of business organization. Why is it the most common form? Because there are several advantages that come with the corporate form of business organization. It is needless to say that there are advantages with the proprietorship and partnership forms of business organization as well, but when we are really looking at the needs of the business, the corporate form is most suitable for the following reasons. Reason number 1, limited liability. The investor's liability is confined to the amount of investment in the company. So the owner's personal wealth is not affected if the firm experiences a loss. If the firm has to be shut down for various reasons, then the investor will only lose that amount that he has invested in the company. So the liability on the owners is limited in the case of a corporate form of organization. Let us say, for example, if there are lenders who have given money to the business, and if the business could not repay the lenders, then the lenders do not have access to the personal wealth of the shareholders or the owners of the business. So this is a very important advantage that the corporate form of organization offers to the owners of the corporation. Reason number 2, death of individual shareholders does not affect the company because the company is seen as a going concern. A shareholding ownership can be transferred from one person to the other in a much simpler and a much easier fashion as compared to a proprietorship from a business. So a death of a owner or a couple of owners does not really affect the business in a significant way. Reason number 3 is ease of raising capital. Remember, a growing corporation needs a lot of investment, and a corporate form of structure provides, facilitates to raise large sums of capital which might not be possible to raise either as a proprietorship or as a partnership. When we look at infrastructure projects require large amounts of capital, and there are limitations in terms of how much we can actually raise in a partnership or a proprietorship form of organization structure. So these 3 are some of the main advantages that we see in a corporate form of organization. Now let us also really understand how is a corporation governed. Like we have a government for the state, we also have a very typical governance structure for a corporation. At the top level, what we have is the owners. The owners, who are also referred to as shareholders of the corporation. So they direct and dictate the policies of the corporation. The owners determine what should be the corporation doing, what business should it actually be in, how should the business be conducted, and so on and so forth. Sometimes the owners manage the business operations directly, but in many instances owners appoint a dedicated team to look at and manage the affairs of the corporation. At the first level, the owners elect what is called as a board of directors to govern the corporation. The board of directors can constitute of owners as well as non-owners of the business, but the board of directors is constituted by the owners and the board of directors is responsible for the governance of the corporation. But the board of directors do not directly govern the operations of the firm. The board of directors in turn, what they do is they select the officers of the corporation. The officers of the corporation could be chief executive officer, the president, etc., who in turn attend to the day-to-day operations of the firm. So in essence what we have is a three-tier structure. We have the owners who elect the board of directors, and the board of directors in turn elect the officers and the management of the company to look after the day-to-day operations. Let us also try and understand what are the different types of corporations. We can really look at it from many angles, but I am going to look at it from two angles that is very relevant for what we are going to look at in this course. At the first level, corporations can be classified by the type of ownership. When you look at the type of ownership, they can be classified into two categories. One is public sector companies and second is private sector companies. If companies are owned by the government, then they are called as public sector companies. Remember, the government is a form of organization in itself, but then government also forms companies to deliver several products and services. So companies which are owned by the government, they are called as public sector companies. One example of a public sector company in India is BSNL. So BSNL is a public sector company which provides telecommunication services. Companies that are privately owned, they come under private sector companies. For example, if you look at Bharti Airtel, which again provides telecommunication services, is a private sector company. So one way of classifying companies is by way of ownership, a public sector company and a private sector company. A second way of classifying the companies is by way of what is known as liquidity. Under this, companies can be classified into two categories: publicly listed companies and unlisted companies or private companies. So when you talk about publicly listed companies, the shares of these companies are listed in a recognized stock exchange, and therefore it provides liquidity to the owners of the business. If existing owners want to sell their ownership, they can sell the shareholding in a stock exchange to another investor who wants to make an investment in the company. In the case of an unlisted company, this liquidity to owners is not so easy, because we do not really have a marketplace where the buyer and the seller can buy and trade in shares. So we can actually have several examples of a publicly listed company. National Thermal Power Corporation, which is one of the largest power generator, it is listed in the stock exchange, so it can be called as a publicly listed company. On the other hand, if you look at Bangalore International Airport Limited, which is a company formed to manage and operate the Bangalore International Airport, it is not listed in the stock exchange. So therefore it is an example of an unlisted or a private company. So if you look at several companies that provide infrastructure products and services, they can be classified under these four categories. Okay, now let us look at what we call as the basics of financial management. Why do we have to really look at financial management? I have explained it briefly at the beginning of this lecture. Let me talk about it briefly once again. At a very broad level, the subject of this course is infrastructure finance, and there are several ways in which you can look at infrastructure projects, but as we have seen, a very common form of a business organization is a corporation form. So therefore, when you are really looking at infrastructure finance as a topic, we are going to really look at infrastructure projects that are structured as a corporation, infrastructure that actually operate in a company format. So we are going to look at how do we actually finance infrastructure projects in a corporation or a company format. So therefore, we talked a little bit about the corporations because we are going to look at companies that are operating in a corporation format. So we need to understand some of the basic advantages and the features of a corporate form of business organization. And the course is all about financing infrastructure projects. Before we talk about financing infrastructure projects, we also have to look at very broad elements of financial management which cuts across any sector. Once we are able to appreciate the basic elements of financial management, we will try and see how these apply in the case of infrastructure, and therefore the next few lectures is going to be in terms of understanding some of these basics of financial management. Once we are more comfortable in understanding the terminology, in understanding the rationale of to why we do some things, we actually get to applying these concepts to the context of infrastructure. Now what do we actually mean by financial management? When we mean by financial management, corporations normally look at making several investment decisions and financing decisions. So fundamentally, making investment and financing decisions comes under what is called as financial management. How do companies decide which projects to invest in? That is one side of the coin. The second side of the coin is how do they raise the capital to fund these projects? So these are two questions that broadly come under the topic of financial management. Okay, but before we even look at financial management, we will also have to understand something that is even more basic, which is to understand the financial statements of a company. A financial statement is an indicator of a financial position of a firm or a corporation. So the information available in the financial statements form a very important input in financial management decision making. So therefore we will have to first understand financial statements and the elements that go into these financial statements, which will help us in turn to understand financial management, and understanding financial management will help us to apply this in the context of infrastructure. So first, understanding the basics of financial management would mean also trying to understand the basics of financial statements. Many of you would come from an engineering background and you may probably not have had an exposure to some of these financial concepts. So I am going to cover it up in a very brief fashion. This is not a course on financial management, so therefore the discussion on many of this is going to be fairly brief, just sufficient to help you to understand the terminologies and its significance as we go into the later parts of this course. When we look at financial statements, there are broadly three types of financial statements. We have the balance sheet, and then we have the profit and loss account, and then finally we have what is called as your cash flow statement. Let us look at understanding what do we mean or what do we actually find in each of these financial statements separately. First, let us take up the balance sheet. While doing so, I am actually going to take an example of a company while discussing many of these elements of the balance sheet. And since it is a course on infrastructure, let us take an example of an infrastructure company and look at some of the elements that we see in a typical balance sheet. And the company that I am going to take is the National Thermal Power Corporation. If you want to know a little bit about the National Thermal Power Corporation, here are the details. This is India's largest power generation company and it is owned by the government of India. So in essence it is a public sector company. The company was set up in 1975 with the objective of accelerating power development in India. Today NTPC is one of the largest organizations. It is the largest power generator in India, but it is also one of the large organizations globally. For example, if you look at the Forbes global ranking, it is ranked 337 out of the 2000 corporations that figure in this Forbes list. In December 2012 it had a generating capacity of about 39,000 megawatts of electricity and it employed about 26,000 people. So it is a fairly large corporation. It employs substantial number of employees. It has large number of generating capacity under various power stations distributed throughout India. Now let us look at the balance sheet of NTPC. So what we am showing here is a snapshot of the various line items that we see in a balance sheet. Remember, this balance sheet is publicly available in the internet, and I would suggest that you download the 2012 balance sheet to understand some of the discussions that we are going to do from here on. Okay, the first thing that you will notice in the balance sheet in the left hand column is titled as balance sheet asset. What do we mean by balance sheet asset? So asset indicates the balance sheet captures the financial information as on a particular date. In India, most of the companies have a financial year that ends on 31st March. So therefore when you look at the company's balance sheet, it actually gives the financial information as of 31st March 2012. So balance sheet is a snapshot of financial information on a particular date. So this is a very important point that you need to keep in mind. Next, if you look at the balance sheet, it broadly comprises of two parts. On the left hand side you have what is called as equity and liabilities, and on the right hand side you have what is called as the assets. Now equity and liabilities is also called as the sources of funds. Remember, a business invests in many projects, but for the investment to happen it needs capital, so it needs funds. Now what are the sources of funds? So the information as to what are the sources of funds is captured under equity and liabilities. What is equity and what is liability? Equity is the investment that is brought in by the owners of the business. Remember, we will also call the owners as the shareholders. In some cases we also call the owners as the sponsors and so on. So these are terminologies that we will keep using interchangeably, and the funds that are contributed by the owners, they are called as equity. They are also called as share capital. In some cases they are also called as net worth. So it is very important that you do not get confused with this change in terminology. All of them refers to the capital that are brought by the shareholders or the equity holders or the owners or the sponsors. The next refers to liabilities. Why do we call liabilities? Liabilities broadly refers to the amount that the firm has borrowed from lenders. So if a firm has borrowed capital from the lenders, it is liable to pay them back on maturity. So therefore these are grouped under liabilities. They are called as liabilities because the company is liable to pay the person who has provided the funds. If you look at liabilities, they can be classified into two categories. One is non-current liabilities. They are also called as your long-term liabilities. What is long-term? So anything that is not due in the next 1 year is called as your long-term in a very general sense. So if a company has actually borrowed money for a long period of time, let us say 3 years, 5 years, 7 years and so on, then it will be classified under your non-current liabilities. Whatever the firm has to repay within a year is classified under current liabilities. If you look under non-current liabilities, there are several items. The first is your long-term borrowings. So as we will probably see later, long-term borrowings will comprise a substantial portion of the amount under non-current liabilities. So these are all borrowings that the company has got from various sources. It could be banks, it could be various retail investors, it could be institutional investors and so on. In addition to long-term borrowings, there are other items that we see under non-current liabilities. These include other long-term liabilities, long-term provisions and so on. I am not going to get into details of those, but in case you happen to download the annual accounts of NTPC 2012, you will be able to find information on these line items in the statement. Next we go to what is called as current liabilities. Current liabilities have 3 line items. The first is trade payables. Now what is a trade payable? The company obtains goods and services from various organizations. Let us say, for example, in the case of NTPC, the company might be, let us say, purchasing telecommunication services, and in most of the cases the purchases made are made on credit. So that is, the company gets some amount of time to pay the bill for the services that it has purchased. So till the time the company is actually making a payment, the company in essence has borrowed from those who was actually supplying or providing the service. So this is an amount that is reflected in trade payable. Trade payable in some instances will also be denoted as an accounts payable. That is, this is an amount that the company owes to various suppliers and service providers for the products and the services that it has consumed. This is an amount that the company is obliged to pay to the suppliers and service providers in the short term. So that is referred to as trade payable or accounts payable. Next we have other current liabilities. This could refer to short term bank loans that are due to be paid within the next 6 months or an year. These are called current because the liability would arise within the next 6 months to 1 year. And there are some other short term provisions that the company has made, which it would have to fulfill in the near term. So in essence, if you look at it, the company's sources of funds are largely threefold. One is the funds that it is receiving from the shareholders or the owners, which is called as the equity capital. It need not get all the capital from the owners, it can borrow some of it, and the amount that the company chooses to borrow will be classified again into two categories. One is a long term borrowing and a short term borrowing. The long term borrowing will come under non current liabilities or long term liabilities, and the short term borrowing will come under current liabilities or will come under working capital. Next we look at the right hand side column. The right hand side column is titled assets. In some balance sheet it will also be referred to as the uses of funds. So it complements the sources of funds. So on the one side we have sources of funds, and on the other side you have uses of funds. The company has raised capital from various sources, and how have these funds been put into use? This information will be available under the asset column. Again, assets are divided into two broad categories: non current assets and current assets. Under non current assets, again there are several line items. The most important is what is called as your fixed assets. So these are assets, or these are investments made in projects, in constructing power plants in the case of NTPC, which helps to generate revenues for the business. In effect, what we mean by fixed assets is these are assets that are created by the company for running the operations of the business. Within fixed assets there are various line items, starting from tangible assets, intangible assets, and so on. So tangible assets are those that can be physically located. For example, we have turbines, we have cooling plants, and so on. So these are all assets that can be physically located. All of this will come under tangible assets. What could be intangible assets? Intangible assets are those that may not really have a physical form. For example, software. Remember, the computer itself is a tangible asset, but the software that resides in the computer can be called as an intangible asset. There are several other examples of intangible assets as well: intellectual property rights, patents, trademarks obtained, they all would be coming under intangible assets. Then next we have capital work in progress. Remember, if you look at tangible assets, these are assets that are in operation for running the business, but at the same time many of the assets take a long time before they can actually come under operation. For example, constructing a power plant takes 3 years, takes 5 years. So till the time the assets are completed and commissioned to operate, the investment that is made is classified under your capital work in progress. Once the projects are complete, then the assets under capital work in progress will actually be reflected under your tangible assets. Like we have capital work in progress, we also have intangible assets under development. For example, developing a software or filing a patent will involve considerable investment, and the investment happens over a period of time. So till the time the assets are created, the investment made in creating these intangible assets would be reflected under your intangible assets under development. In addition, under the non-current assets we also have non-current investments. So these are all the investments that the company has made in various avenues. For example, the surplus funds that the company has could be invested in bank deposits, it could be invested in other return yielding investments like government bonds and so on. So these investments do not directly contribute to running the company's business, so therefore they are classified separately under non-current investments. The third item is a long-term loans and advances. The company could actually provide loans and advances for various purposes. For example, it could actually provide a loan to the employees of the company to construct a house. So advances made for such purposes will be classified under your long-term loans and advances. Next we look at the current assets. Current assets, there are current investments, which is a short-term investments made under various investment opportunities. Then we have inventories. Inventories reflect the raw materials that the company has purchased, but it is not been used yet. For example, NTPC might actually need to purchase coal for generating power. The company at any point in time would need to have surplus amounts of coal so that there is no shortage of raw material to generate power. So the investment that is made in this raw material would be classified under an inventory. Remember, this is a current asset. The investment made in coal is not expected to be there forever, but it is expected to be used in generating power for the business operations. Then we have trade receivables. Trade receivables is the opposite of trade payables. In the case of trade receivables, NTPC generates power and it supplies power to various consumers. So in this case it could be various state electricity boards, or it could be large customers like the railways. Now the customers that actually purchase power from NTPC also enjoy a credit period. So trade receivables indicate the amount that the customers of the company are expected to pay to NTPC in the short term. That is, this is an amount that the company expects to receive from its customers for the products or services it has provided to them. Then we also have cash and bank balances. Any surplus amounts that are there in the various bank accounts is reflected under this line item. There are several short-term loans and advances that the company could have been made. If there are any short-term loans and advances, then it gets reflected under this line item of the current assets. So what we actually see is, on one side we have what is called as the sources of funds, and on the other side we have what is called as the uses of funds. And the balance sheet provides information on what are the different sources of funds to the company and what are the uses of the funds that the company has put use to. So the left hand side reflects the financing decisions made by the company. How has the company financed various projects? Has it financed by way of equity? Has it financed by way of borrowings? If it has financed by both equity and borrowings, what has been the proportion of borrowings? Has it financed by long term borrowings, or has it financed by short term borrowings? Of the total borrowings, how much of it is short term and how much of it is long term, and so on. On the right hand side of the balance sheet, it looks at what are the different areas in which the funds have been utilized. In essence, the right hand side of the balance sheet looks at the investment decisions that the company has made. So there is a financing decision and then there is an investment decision, and the information in the balance sheet reflects both the decisions put together in a single place. So before we end this lecture, thought questions for this lecture. Question number 1, can you provide examples of companies in the infrastructure sector for each of the company classifications that we discussed in the lecture? Remember, we talked about 4 classifications: public sector companies, private sector companies, publicly listed companies and unlisted companies. So for these 4 types of classifications, can you provide examples of companies? Question number 2, we have had an overview of the balance sheet. Now take some time to look at the balance sheet of NTPC, and then are there anything interesting that you can observe in the balance sheet of the corporation? So think on these 2 questions and we will discuss this in the next lecture.